Equity markets are currently defined by a localized surge in artificial intelligence, a boom that has fostered a distinct sense of investor complacency. This split-screen chart illustrates the friction in the current system. On the left, we see an accelerating upward curve in equity valuations, which sits in direct opposition to the declining step chart on the right, tracking GDP and sticky inflation. These two trends describe such different economic realities that traditional financial analysis is failing to reconcile. To find the true systemic risk, we have to map the actual macroeconomic data from the second quarter directly against the internal composition of the S&P 500. We call this analytical framework the macro-micro divergence. The index itself operates with a different mechanical structure today than it did during any previous economic cycle. This shift suggests that the S&P 500 may no longer function as the diversified economic head that many investors still assume it to be. We start with the top-down data, beginning with the highly anticipated second quarter GDP advance estimate. This line chart tracks recent quarterly growth, showing that the U.S. economy slowed to a 1.5% growth rate in Q2. The severity of that drop is best measured against the consensus expectation, which sat a full half percentage point higher at 2%. However, looking at the labor market reveals an immediate contrast to that decelerating growth. Initial jobless claims came in at 197,000, remaining notably below the 200,000 mark. Continuing claims also remain mathematically contained, holding steady below the 1.8 million threshold. These employment figures reflect a level of containment not consistently seen since the late 1960s. This creates a precarious baseline. Growth is rapidly slowing, but because employment hasn't broken, the economy is entering a highly specific, high-friction phase. The primary friction point grinding against that slowing growth is the current inflation matrix. Baseline inflation expectations were initially met, with core PCE year-over-year landing on target at 3.3%. But a critical outlier is hidden within the second quarter data. This bar chart isolates that core PCE against the second quarter pricing index, which printed at an elevated 6.2%. That 6.2% print stands in stark contrast to the original market expectation of approximately 4%. When we zoom out to look at the historical data, this is the highest print observed since the second quarter of 2022. Combining 1.5% growth with a 6.2% pricing index creates a distinct stagflationary tilt. The bond market is already reacting defensively to this data. We can see this in the rapid steepening of the yield curve, specifically in the spread between 2-year and 10-year treasuries. In just 1 month, that spread moved aggressively from 24 basis points to 42 basis points. This violent repricing in bonds signals looming structural friction for overvalued long-duration risk assets. To understand why that friction matters, we have to look past the macro data and into the bottom-up mechanics of the S&P 500. Historically, the index functioned as a broadly diversified proxy for the entire U.S. economy. A traditional 6% allocation in the oil and gas sector once served as a natural hedge. If energy expenses in your daily life went up, that portion of your portfolio typically provided a balance. But recent market cycles have shifted the S&P 500 away from this broad base. This tree map visualization shows the current state of concentration. More than 50% of the S&P 500 is now allocated strictly to technology and tech-adjacent firms. This massive concentration is a direct result of the localized exuberance surrounding AI. This shift has been accompanied by a systemic lack of fear regarding downside risk among both retail and professional investors. Gains like a stock doubling from $300 to $600 in 6 weeks are being treated as a baseline expectation rather than a mathematical anomaly. For many, simply learning the new language of AI has created a false sense of fundamental investment expertise. The result is a market treating the S&P 500 as a low-risk, diversified asset at the exact moment it has become a highly concentrated, tech-heavy bet. When we layer these two realities together, the macro to micro predictive model becomes clear. Holding a high multiple 50% tech portfolio in the current environment carries significant mathematical danger. The top-down macroeconomic pressures are applying immense force to these valuations, with 1.5% growth now colliding with 3.3% core inflation. The bond market is already providing an explicit warning through the steepening yield curve. These factors combined suggest that investors are highly exposed to a severe, sudden repricing event. Because the mechanical structure of the index has changed, traditional passive investing assumptions about its risk profile should be reevaluated. The macroeconomic friction against this concentrated market structure creates a setup where, despite recent behavioral complacency, the historical reality remains. Stocks do inevitably go down.